In the middle of all the noise and chaos of the market, there's this one signal that represents a moment of perfect, deafening silence. It's a single candlestick that tells a whole story, one of conflict, balance, and major potential change. Today, we're going to dive deep into the doji. So, if you've spent any time looking at a price chart, you've probably seen it. This little cross-like symbol that just kind of stands out because it has almost no body. So, what is the market actually trying to tell us here?
Well, this is the doji, and its defining feature is that the open and closed prices are pretty much identical. The name itself is fascinating. Doji is actually Japanese for mistake because it's so rare for the open and close to be exactly the same. But for us traders, this so-called mistake is a really powerful signal. It means the market is in a perfect stalemate.
So, what is actually happening behind the scenes to create this pattern? Well, it's nothing less than an all-out tug of war. I want you to imagine this. The trading session opens, and the bulls, the buyers, they start pushing the price way up. But then the bears, the sellers, they fight back and shove it all the way down. But just when it seems like the bears have won, the bulls rally one last time, and the price closes right back where it started. After all that fighting, it's a draw. And that right there is the picture of market indecision. Now, you might see a doji with a teeny tiny green or red body and wonder, hey, does that change things? And the short answer is, not really. Green just means the close was a tiny fraction higher than the open, and red means it was a tiny fraction lower. The price difference is so small, it's almost nothing. The core message is exactly the same. Indecision is in charge.
But here's where it gets really interesting. While all dojis signal a pause, they are not all created equal. Their different shapes tell us a little more about the kind of battle that just went down. So let's break down the 5 most common variations you're going to run into, because each one tells a slightly different story. Okay, these two are the real heavy hitters. The Dragonfly, which is shaped like a T, shows that sellers tried to hammer the price way down, but bam, the buyers stormed back with incredible force and closed the session right at its high. That is a powerful rejection of lower prices. And the Gravestone? It's the exact opposite story. Buyers pushed the price up, but sellers completely overwhelmed them, slamming the price right back down to the open, a huge rejection of higher prices. Now, the long-legged doji, which is sometimes called the Rickshaw man, this thing signals a totally chaotic session. The price traveled a huge range, both up and down, but ultimately closed right back where it started. Those long wicks are telling you there was a massive fight, but it ended in a dead heat. This means extreme uncertainty. And then there's this one, the true unicorn of the group. The 4-price doji is literally just a flat line. The open, high, low, and close are all the exact same price. It's the ultimate sign of indecision, or a market that's pretty much just gone to sleep. All right, so identifying a doji is one thing, but understanding what it means, that's a whole other ballgame. And the secret isn't just in the candle itself. It's all about where you find it on the chart. Okay, this is probably the most important thing to get right. A doji is a question mark, not a final answer. It doesn't scream reverse. It just whispers, hey, the momentum might be fading here. Never, ever forget that. So let's paint a picture. Imagine a long, strong uptrend. Prices have been climbing for days. Everything's looking great. Then, suddenly, a doji appears. This could be the very first sign that the buyers are just running out of gas. The buying pressure that fueled the whole trend is now being met by equal selling pressure. The market is pausing to catch its breath. And you guessed it, the same logic works in reverse. After a steep drop in price, a doji suggests that the sellers might finally be exhausted. Buyers are stepping in with enough force to stop the bleeding. This could absolutely be the turning point where that downtrend finally loses its power. But what if the market isn't really trending at all? What if it's just chopping around sideways? Well, if you spot a doji right in the middle of that mess, it's usually just confirming what you already know. Nobody's in control. It basically reinforces the idea that the market's probably going to keep going sideways for a bit. Okay, now for the really practical part. How can we actually use these insights to make smarter, more informed trading decisions? Let's turn these signals into action. Here is a clear, repeatable framework. It's a simple 4-step process. Step 1, you spot the doji. Easy enough. Step 2, you analyze its context. Where is it in the trend? Step 3, and this one is the absolute key. You wait for confirmation. And finally, step 4, if you do take a trade, you manage your risk with a stop loss. Now let's talk about the common mistakes, the traps people fall into. The biggest one, by far, is just assuming every doji is a guaranteed reversal. It's not. Another big one is trading it all by itself. But the most crucial mistake you can make is acting on the doji before the market has shown you what it's going to do next. This brings us to the single most important rule when it comes to trading doji patterns. Seriously, this is the idea that separates disciplined traders from people who are just gambling. I want you to remember this phrase. The doji is just the setup. It's the moment of hesitation. The real information, the decision, comes from the very next candle. Think of it this way. The doji asks the question, is this trend over? The candle that follows it provides the answer. A big, strong green candle after a doji in a downtrend confirms, yep, buyers have taken over. A big red candle after a doji in an uptrend confirms, okay, sellers are in charge now. And what if you see more than one doji in a row? Well, that just amplifies the signal. 2 dojis back to back shows some serious indecision. It's like the market is coiling up like a spring for a potentially huge move. And 3 in a row? That's known as a tri-star pattern. It's super rare, but it's a very powerful signal that a major reversal is highly likely. So let's lock in the key takeaways from all this. Number 1, a doji means a draw, total indecision. 2, its meaning comes from its location, its context. 3, different shapes give you different clues. And 4, the golden rule of them all, always, always wait for confirmation from that next candle. Ultimately, the doji really does present this moment of perfect balance in a really chaotic market. It flags a critical junction. Your job isn't to guess. It's to read the context, wait for the evidence, and then see which way the scales finally tip. The only question is, are you ready?